How to build your wealth and keep it. This video is for educational purposes only and should not be considered financial advice. In this video, we're going to show you how to build your wealth and keep it. We're going to provide an example of how you can set up your own banking system and loan money to yourself to make important purchases. After you have paid yourself back, like you would a bank, your money will still be there and will have also increased with interest. Does this sound like something you'd be interested in setting up?
Oh yeah.
Well, good. If you stick around, we'll show you an example of how you can use this method to create passive income streams to grow your wealth exponentially. What you're doing now. Many times, when people need to make a large purchase, such as a car, house, student loan, vacation, or home renovation, they borrow money from the bank or a credit card to make this purchase.
Ouch.
When you pay off your credit card or a loan company, you are paying them extra money that is called interest. This extra money can amount to sometimes half the amount that you borrowed, or even more. What you can do instead. How would you like to set up a system where you get to keep that extra money?
Yay!
This can be done through the use of a whole life insurance policy. Now, I know you are asking, what does life insurance have to do with creating wealth? Well, let me tell you of a few people who have done exactly this. John D. Rockefeller. You know, Rockefeller Plaza. John D. Rockefeller used his whole life insurance policy to finance a lot of the expansion of his Standard Oil Company. By sidestepping traditional lenders, he retained greater control over the financial trajectory of his business, and he minimized his dependence on external forces. It was a large part of his strategy. This financial autonomy allowed him to make bold and calculated moves, contributing significantly to the expansion of his business empire. Walt Disney. When Walt Disney was unable to secure enough money from a bank loan, he borrowed against the cash value of his life insurance policy to help finance the creation of Disneyland. Ray Kroc. When Ray Kroc bought out his partners at McDonald's, he used the cash value from his 2 life insurance policies to cover the salaries of certain employees. He also used the funds for a marketing campaign for the new mascot, Ronald McDonald. And a host of other people have used this vehicle to build their wealth and retain it. How it works. After you have obtained a whole life insurance policy, you will make monthly, quarterly, or biannual payments into your policy, thus helping it to grow. These payments are what's called the cash value of your policy. It is this amount that you will be borrowing from. Thus, it is important for you to have some type of steady income to continue to make your insurance payments. Now, we say payments, but it is actually your insurance investment, because that money is yours. You are not paying somebody for that policy after your initial setup. You are paying yourself. The money that you are putting into your policy is growing along with the original amount of the insurance. After about 14 years, you can probably stop making payments and the account will just regenerate itself. However, this is not advised because you want to continue to grow your wealth. What you want to do is use the cash value of your policy to borrow from to pay off those big expenses we mentioned, such as a vacation, a renovation, or other big purchases. After you've made your purchase, you'll want to start to pay back yourself just as you would a credit card company with interest. This way, you are putting more money back into your bank and not someone else's. This process is called wealth recapture. Now, you are not paying that extra money to a bank or credit card. You are keeping that yourself and it is continuing to grow inside of your policy because whole life insurance pays a dividend. There is an interest charge for borrowing the money, but one of the mind-blowing facts of this method is that you will be receiving dividend payments on the full amount of your policy of up to 7% a year. And when you take a loan from your policy, the interest rate is only 5%. Thus, you are practically making money while still borrowing money. You will still be making a dividend of 2%.
You just got money.
Now, normally you will not borrow the full amount of your policy, and thus the real percentage interest rate of the amount you borrowed will be even smaller than the full 5% interest rate that you're being charged. This is how you create your own banking system and grow your own wealth instead of helping somebody else grow theirs. Real world example. The most optimal way to use this strategy is to borrow from your policy to purchase an asset that will grow more than 5% a year, which is your interest rate. This way, you can make even more money borrowing from your policy. For example, if you borrowed $10,000 from your policy and invested it into JEPQ, the JP Morgan ETF that tracks the NASDAQ, at the end of the year, you will have paid $500 in interest. However, JEPQ pays a yearly dividend of 10%. That means you will have made $1,000 from your investment. And if you subtract your interest, you will have made $500 total. As promised, we'll show you an example of how you can use this method to create passive income streams for substantial wealth accumulation over time. Let's say you didn't pay back the $10,000 for 10 years and kept buying shares of JEPQ. You would have doubled your money to $25,937 in 10 years' time. Now you can pay back the initial $10,000 and the interest of $6,288 and have $9,648 invested in JEPQ, earning you around $1,000 a year. Do this for a number of investments, and you can see the potential for explosive growth. This is how you use a whole life policy to build and keep your wealth. Summary. As you can see, whole life insurance provides a strategy for creating personal wealth by establishing your own unique banking system. Instead of relying on traditional loans from banks or credit cards, you can make regular payments into the insurance policy, accumulating cash value that can be borrowed for major expenses. The borrowed funds can also be invested in assets, and as these assets grow, there is the potential for substantial wealth accumulation over time. We hope you've enjoyed watching our video, and please like and subscribe for more videos like these. If you have a question or comment, please post it in the comment section below. Thank you for watching.